From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and thanks for tuning in to today's episode of the Macrocast. I'm your host, Ilan Mui, a managing director at Penta. My co-hosts are John Fagan and Brendan Walsh of Markets Policy Partners, and our special guest today is John Dick, founder and CEO of Civic Science. Hey guys, how y'all doing?
Doing great, Elon.
Fantastic. Well, we have got a very big show today and a full house, so we're going to just jump right in because we heard a lot of Fed speak over the past week, both from the regional bank presidents as well as, most importantly, Fed Chair Jay Powell, who is testifying on Capitol Hill. And during his time before lawmakers, Powell tried to defend and even tried to maybe define the Fed's decision to hold interest rates steady at its last meeting. He was adamant that this was not a pause, but at the same time, he also sort of acknowledged that this is a temporary stoppage because he signaled that the Fed would likely continue to hike rates later this year. Likely they've got two more 25 basis point increases before the year is out. So it seems to me that this is actually the definition of what the markets are calling a hawkish pause. But John, what do you think about what he said?
Yeah, it really does follow on from that hawkish surprise, that element in the June decision that was really centered around the dot plot, the prediction of the various members of the FOMC about where rates were going, and that additional 50 basis points, that was 50 basis points higher essentially than where the median had been at the March meeting, which was the previous published estimate. That really was where, the rubber met the road in terms of the Fed's hawkish surprise, and this was, a reinforcement of that. The idea that this is, skip a meeting. There was it's still a little bit difficult to understand exactly if there's significant urgency and you've got two more rate hikes in you. Why would you give a miss to the June? Why wouldn't you just get on with it? That's been the kind of criticism, I guess, or the Monday morning quarterbacking that everybody likes to perform with Federal Reserve decisions. But this sort of hammered home the fact that we've probably got, at least one more. That's where markets were kind of coming into this. The reaction to the speech really hasn't been all that dramatic in futures markets. It's bumped up the odds for another hike at this upcoming meeting here in July, but the idea that you can, whether there's another one behind it sort of in the fall, there's a sense that the economy is probably going to slow down and inflation is going to cool further in line with where the Fed wants it to go. And so that, 50 basis points is not priced in. It's an additional 25. And the most importantly, I think, we've been talking about how cuts, which had been reflected in the pricing of futures, pretty aggressively before year end through much of the spring have been priced out dramatically. And it's essentially showing the Fed being, largely one more hike at the July meeting and then on hold through year end.
Yeah, and it seems like, one of the reasons you saw that big shift in the dot plot, I believe there were at the previous meeting, there were 4 FOMC participants who saw two more rate hikes by the end of the year. At this most recent meeting, it was 12 who saw 2 more rate hikes by the end of the year, is because that the economy has been surprisingly resilient. That, Powell pointed to the fact that consumer spending remains strong. The labor market is still tight. And I feel like, John Dick, that we're seeing that in the economic sentiment index that Penta and Civic Science puts together as well. I mean, it saw a big jump in the past 2 weeks in terms of how consumers and Americans are feeling about the economy. So there's still a lot of strength there. So maybe that means the Fed has more room to run.
Well, the consumer's definitely feeling pretty good right now. I mean, we know not to rest on our laurels with that because it can, fall as fast as it goes up. But yeah, this was the biggest jump we've seen in the ESI in almost a year. We're almost to the high point for the calendar year. We're catching up to January a bit, but yeah, I mean, the consumer's feeling positive. They're clearly out there spending money. Even, gas prices are sort of stabilized, which we, going into the summer is a real issue as people are getting on the road to travel because we're seeing more car travel than air travel just year over year as people are looking at ways to sort of cut spending a bit, but having sort of leveled off gas prices is good. They're feeling really, even still really good about the job market. There's a sense that maybe it had tightened a bit, but it's not showing up in people's attitudes about it. We're just, let's continue to ride the wave, I guess.
Yeah, the Economic Sentiment Index measures consumer sentiment across 5 different areas, including making major purchases, the labor market, the overall economy. But I thought one that was interesting was that confidence in buying a new home actually rose 0.6 points to 23.6. But that is coming even despite the fact that mortgage rates maybe aren't as high as they once were, but they're still fairly elevated when you think of how long we spent at like 2 and 3% interest rates.
Yeah, but also too, the prices have also sort of calmed a bit as well. And I think consumers intellectualize that a bit more than they do interest rates when we ask them about the housing market. So that's certainly a big part of it. I mean, it's not often, even when we see big jumps like this, it's not often that we see all 5 indicators climb, and they all did. Even the one that I pay the most attention to is people's sort of longer term outlook for the economy. So we ask about sort of how they feel it's going to be better or worse in 6 months. So not only do they feel good today, but they feel like it's actually headed in the right direction and have a positive outlook for where things are going. I realize that's sort of a double-edged sword when it comes to the Fed, because they maybe want to tamper down some of that enthusiasm, but it's not hitting the consumer yet, that's for sure.
Do you see any headwinds on the horizon for the consumer? I mean, I feel like they've just been a powerhouse of the economic recovery really since the pandemic kind of got in the rearview mirror. Is there anything that you see on the horizon that could maybe dampen that enthusiasm?
Well, I mean, certainly the unforeseen is what we've learned that over the last 3+ years. But, one thing we're paying really close attention to is the return of student loan payments in the fall. I guess the invoices show up in September and the bills are due in October. That's going to have a pretty significant impact on different pockets of the economy. There's almost $1.5 trillion of federal student loans out there, held by about 43 million different people. That's a lot of money. That's just sort of people have been able to stockpile for the last couple of years. And it's not going to hit the economy evenly. If you think about who has student loans, they tend to be younger to, Gen Z to sort of younger millennials for the most part. Where do those people shop? What do they buy? In fact, we just wrote up a study this week. One of the areas we think is going to get hit pretty hard is like restaurant delivery services like DoorDash. I mean, if you look at the frequency of consumers, the frequent consumers who use those services extremely over-index as student debt holders. So that's kind of an easy thing for people to cut back when they need to cut back. There are certain retailers we think will be affected more than others, sporting goods retailers, things like that. It's a little early. But it's also kind of unfortunate timing that's going to happen like right when people are gearing up for the holiday retail season.
Yeah.
The timing, maybe they could have done it in April or something. I don't know, but it's not great timing. Great timing for the retailers. That's something they should be concerned about.
Wait, John Dick, are you saying that do you think that all restaurants are going to be affected, or just the delivery? Like, are all these millennials and Gen Z going to have to actually walk to go get their chalupa or whatever it is, the house?
Yeah, well, look, I mean, obviously the QSR category and the fast casual category, irrespective of delivery or not, I mean, that's where the demographic of student debt holders tend to go out to eat the most often. So this particular study we did this week just looked at the delivery category, but we'll dig into the restaurants as well. And yeah, they'll be hit to varying degrees of severity, I think, just based on who their customers are.
And Brendan, it seems like, all of the sort of dips from the Silicon Valley Bank crisis or maybe even sort of mini crisis, if you will, that we saw in the regional banks earlier in the spring, earlier this year, that seems to have just evaporated from consumers' memories now.
Yeah, definitely from the consumer, but also, we get weekly data from the Fed on, bank deposits. So that's definitely stabilized. You're not seeing, deposits flow out of smaller banks and medium size into the larger. That's abated. But lending definitely has slowed. And I think that's a combination of both. You're a little worried, about future capital. We had some hearings on the Hill about that also this week. but also I think just the overall economy, and also, small and medium-sized banks make a lot of commercial real estate loans. So that's a sector that no one really wants to, get too overexposed to right now. But overall, I think that the banking sector is sound, but it's not going to be a huge force for stimulative growth in the economy.
John, just back to you for a second. The indicators ticking up here in the most recent reading. What are you picking up about summer plans? Last summer was such a, it was kind of like everybody's plans had been put off for a couple of years almost. And last summer was the big splurge. People doing those trips and, overseas or closer to home, road tripping that they hadn't done in a while, catching up with family and friends and so forth. What's this summer going to look like based on what you're seeing?
We are not seeing any cutback at all in travel. The type of travel, yes, a little less airline, definitely a lot less overseas, right? Those were the sort of, revenge travel things last summer. But, we've talked a lot about this, we're in this sort of like era of well-being right now with consumers where they're just really prioritizing spending categories and decisions in their lives that are about sort of like mental, emotional, and social wellness, and travel's the top of that list. So we're seeing more camping, we're seeing more road trips, we're seeing a little less sort of long, cross country and transatlantic travel, but people are still highly prioritizing. And frankly, look, I mean, the fact that, such a large sector of the economy is still in some mix of remote to hybrid work just affords more flexibility to travel, right? You can travel somewhere for a week and work for 3 of those days from a cabin in the woods or a lake house if you want. We're just seeing a lot of that.
I like the analogy that Chair Powell used during his testimony. Economists love to use the driving the car metaphor for how they're thinking about steering the economy. But I thought this one was really good, actually. And he described the Fed's current pace or stance as the Fed is driving the car off the highway and getting closer to its destination. And when you're on the highway, you're going pretty fast. It's what the Fed did over the past however many months, 18 months or so, 10 rate hikes, et cetera. But now that they're getting close to the destination, you slow down a little bit because you're in the neighborhood and you start to pump the brakes maybe a little bit or let off the gas on the car a little bit as you try to find out if you're actually coming to the final point here. And so I thought that was a really apt analogy, but I started to carry it even further in my mind, which maybe is a dangerous thing, and wonder what happens if when the Fed stops and it knocks on the door of the house it's trying to visit and it realizes it's at the wrong location. It went to the wrong address.
Well, that's traditionally the way.
Reverse and go the other direction. That's
traditionally the way that the tightening cycles have ended, not with the Fed arriving at home, but more like driving it into a ditch. Soft landings are not the usual outcome of tightening cycles, and it's a really difficult, it's just a really challenging thing, clearly, to calibrate it with the lagged effects and all of the exogenous factors that you can't correct for, and so the Fed as an institution doesn't have a great track record of doing that and avoiding that ditch before it makes it to the destination that it wants to get to.
Yeah, and we're also hearing from some regional bank presidents and others who think that maybe 2 more rate hikes by the end of the year is maybe not the way to go. We've heard from Raphael Bostic, who's the president of the Atlanta Fed. He used also an interesting phrase, which is passive tightening. And his argument was that as you see inflation start to moderate, that real interest rates are actually then more restrictive. And so that the Fed doesn't actually have to do anything. It just can keep rates steady and actually have tighter conditions. I'm curious what you guys think about that. Do you think that's a valid way of looking at things and whether that might have a big impact?
Absolutely. I think that's right on. And just what you said, the way that you characterized it, the conditions change. And that's one of the reasons, that's the exact justification for why they skipped in June, to slow down the pace and give them an extra month of data to learn how the economy is playing out. The Fed is very straightforward about the fact that these are forecasts and not anything set in stone. And so I think it's a very prudent formulation.
Great. Well, we are going to talk more about the Fed, but we're going to take a short break right now. When we come back, we'll discuss the banks as well and some new bipartisan movement on that front. Don't go anywhere.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
And we're back with the Macrocast. I want to start by talking about something that might feel a little shocking in Washington, which is a bipartisan bill. This week, the Senate Banking Committee passed a bill that was sponsored by the Democratic chairman of the committee, Sherrod Brown, as well as the ranking Republican, Tim Scott, that would essentially allow regulators to claw back compensation from executives at failed banks, such as SVB. The bill is called the Recoup Act, and it gives regulators the power to remove and even ban executives who demonstrate misconduct. And again, it allows the FDIC to claw back compensation from executives, including through stock sales, as well as incentive-based compensation through bonuses, et cetera, for the 2-year period before the bank actually failed. So this is a pretty important piece of legislation, something that lawmakers have been talking about since all the trouble began in the banking sector. And I'm curious, Brendan, if you think that, one, this is even effective as a means of deterrence, or if this is just, politicians trying to make some waves.
I think it was kind of inevitable, because what happened with Silicon Valley was pretty egregious. You had like the CEO selling like stock a couple of days before it went under, things like that. So I think, you
don't have to go back 2 years. You can just go back like 2 days, right?
Yeah. So this one wasn't really a hard one to investigate. So, I have some friends that are bank lobbyists, and, while they don't love it, they know this was inevitable. So you just want to try to make it as reasonable as possible. And I actually think that this is a fairly reasonable bill. I would imagine that it will have some effect, in deterrence. What happened with Silicon Valley really was, it wasn't a macro thing, and it wasn't even bad lending. It was just bad management of their book. The leadership walked away, perfectly fine. They don't have a job right now, but they still have all the money that they had. Knowing that you can get that taken away, I think will play, at least a small role in better governance of the banking sector.
Yeah, I just think back to the financial crisis and, how much outcry there was to hold executives personally accountable for what happened, to the economy. And, I don't feel like that really happened. And so maybe this is Washington's way to try to ensure that, in the next round, if there is one, God forbid, there's always something that's going to come across the horizon, that this time they have more tools in order to make sure that these guys don't walk away scot-free, and that they don't walk away with all their money and all of their consumers' money. I do think that this legislation, while it has momentum in the Senate, it seems like there is some opposition to it over in the House side. They're sort of forging their own path. Maxine Waters has released a whole package of bills that would, reach a similar outcome, but maybe go a little bit further, including requiring more stress tests for smaller banks, expanding the limits on whether when a executive cannot perform a stock sale, et cetera, when those funds can be clawed back. So there seems like there's two different tracks here. I'm not sure how much both chambers are talking to each other.
Yeah, I think, especially on the lobbying effort, I think the Senate was in unison of what this should be. But I think the House side is going to be pandemonium. I think a lot of stuff's going to get thrown in, both from the left and the right. So the bill that ends up passing the House, I think, is going to be very different than the Senate, and I'm not sure it's going to be palatable for the Senate to what gets sent back to the Senate. I'm not sure it's going to be palatable for the Senate to pass.
Yeah, assuming the House can even pass a bill, right? I almost wonder
it might not even get there. Yeah.
I mean, I almost wonder, if the Senate drives the train here, and if the Senate is able to pass a bill in a bipartisan fashion that to some degree holds executives at these banks accountable and sends it over to the House, can the House not pass it without it looking really bad? Because ultimately it is an outcome that both parties want to see.
Yeah, that's the irony of it. I think both sides agree but I think the House is gonna throw so much nonsense in it that this thing might die.
Yeah, it's tough when these bipartisan issues, get bogged down in sort of partisan details. I guess is part of the problem on Capitol Hill. One area, though, that we've also seen that there's been, maybe surprising bipartisanship is on Fed nominations and Fed confirmations.
Yeah,
I feel like last year it was much more, and even thinking back to Sarah Bloom Raskin, it was much more controversial. The Fed was in a lot of political hot water, but it seems this time around, it's not quite the political lightning rod that it had been. So this week, the Senate Banking Committee also held confirmation hearings for Philip Jefferson to be vice chair, for Governor Lisa Cook to have a full 14-year term, and also for the economist Adriana Kugler to join the Board of Governors. She would become the first Latina to serve. I don't know how much you guys follow this, but any top takeaways from, either how they would approach, how Adriana Kugler in particular would approach the position since she hasn't been on the board before. But any thoughts on how their nomination hearings went?
Yeah, so they all released written statements a couple days ago, and they very much echoed the sentiment from Powell, both at the press conference after the meeting last week, but also his Humphrey Hawkins testimony today. That inflation is still too high, and we need to maybe hike some more. So I don't think anything hugely interesting came out of their testimonies and appointment hearings. But a little bit wild card is
Adriana Kugler. I hope I'm pronouncing that correctly. Yeah.
Who seems very interesting, and her academic background is very impressive. But I think she would also maybe be a little more of a dovish voice on the board.
Yeah, I thought it was interesting. I was just reading about her history, and she studied at Berkeley. And while she was there, I believe one of her advisors was George Akerlof, who happens to be the husband of the one and only Janet Yellen. So I guess we sort of understand what mold.
Yeah, and he's a very liberal labor economist. Sure. So if she studied under him, that she would definitely prioritize full employment, maybe a little bit frothy inflation.
Sure. And you think too about how long Janet Yellen sort of insisted that inflation was transitory. I remember her distinctly saying at the end of 2022 that she thought, well, this was maybe the middle of 2022, her saying that she thought it would be, back down by the end of the year. And clearly it's not how things played out. So we'll see what she adds to the board.
It was definitely stickier than they thought, but actually the San Francisco Fed just released a paper 2 days ago that showed that 60% of the increase in inflation over the last couple of years was directly related to supply chain disruptions caused by COVID. So I think they actually were right that this was transitory, but they were wrong in how high inflation went and how long that transitory time frame lasted.
So maybe the error was not in thinking that inflation was transitory, but underestimating the amount of time it would take to fix the supply chain.
Yeah,
fix the factors.
Just how high certain prices went, and it was also prices that really hit people, in the pocketbook. Especially, car prices went crazy high, but food went up, and that was a big deal.
Yeah, and speaking of China, I mean, I think that another sort of dynamic that the Fed is having to contend with here is that China's reopening is maybe not the global economic stimulus that folks had been anticipating. I believe that China's central bank maybe cut maybe not the key interest rate, but one important interest rate. And so China is trying to find ways to actually pump up its economy as it opens up its doors.
Yeah, it really has been kind of a bummer in terms of the recovery. There was a sense at the end of last year when they were peeling off COVID zero very rapidly and publishing a 16-point, property support plan, and everybody was getting excited. But when the property sector has a lot of legacy debt, it's pretty sickly. It is it's a money. It's essentially a flaming barrel that you can throw a lot of money in without good results. It's capital destruction, loss, unrealized losses, what have you. Describe it as in a variety of different terms, none of them particularly good. And so trying to stimulate the economy through the property sector is it's a tough path to go down, but they've doubled down on it. Not only did they cut interest rates, obviously that's for, broad economy, but they announced, augmentation to the 16-point property support plan and more essentially verbiage and rhetoric coming from Chinese leaders about stimulating the economy. It's not clear that is going to be showing up in the data anytime soon. The forward leading indicators that you see, like credit extension, have been really soft for the past couple of months. And so, if we're going to have any of this stimulus really feed through to a bump in activity, it's probably going to take some time. And we're not optimistic even that this, double down property support is really going to give too much juice. Look no further than like copper prices, iron ore, steel. Typical oil. Yeah, very, very soft, and telling a story about weak demand in the industrial side. We saw a lot of purchasing managers indexes coming out today. We've got China's next week, but Europe came out this morning. And manufacturing, this has been a trend for a while of services looking, relatively steady and expansionary, but manufacturing looking just awful. And that is borne out by these latest PMI data as well.
So on the one hand, we have China trying to ease, we have the US holding steady, and then we have the Bank of England surprising with this, double-barreled rate hike. What's happening there?
Well, their inflationary problem has just been it's really been dramatically worse than a lot of other parts of the world. They've had, whether it's, point your fingers at a variety of different things. We had the Liz Truss episode where the pound got tanked and UK gilts got smashed by an ill-conceived fiscal program that she announced. There's some, that's problematic. Brexit is always in the headlines about feeding through and challenging the economy in ways. It's inflationary. It seems, based on what we're seeing with the very sticky high inflation, it's not as though growth looks particularly good. UK PMIs came out, and the manufacturing PMIs were absolutely awful. The services were, still relatively solid, but we're not as good as expected. And the Bank of England is clearly, going to be raising rates aggressively into a pretty dismal economic situation that isn't clearly, it's not clear that a recession would really be all that helpful in terms of getting some, food prices down, for instance.
So, John Dick, I guess this means that the U.S. consumer might be in the best shape of anywhere in the world. Even can we hold everybody up?
Yeah, I don't know if we can hold everybody else up, but I mean that's been true for 2 years, right? There's a political sector out there that don't seem to care what's going on in the rest of the world and don't really evaluate us on a curve, but they should, because we're much better off.
Great. Well, there's a lot that happened this week, but certainly a lot more on deck next week as well, including, I guess, the result of bank stress tests. Brendan, what's on your radar screen?
So we get Chair Powell gives 2 more speeches next week, so we'll see if he changes any of his tone from his testimonies here. But we get a decent amount of inflation data in Canada, in the Eurozone. And then we get a lot of housing data here in the United States. So nothing's going to massively move markets, but it'll continue to paint that picture of if, especially on the inflation front, if the rates are kind of normalizing, or if it's going to kind of get sticky at these levels.
Okay, well, we'll be watching all of it. But for now, thank you to everyone for listening to the Macrocast. I'm Ilan Moy with Penta. My co-hosts are Brendan and John from Markets Policy Partners. John Dick of Civic Signs also joined us with his insights. We really hope you enjoyed our show today. Please remember to like and subscribe to the Macrocast wherever you get your podcasts. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.